Ben Bernanke came out with an optimistic tone on the US recovery and continued to remain accommodative for as long as it takes, unquote, for the robust recovery to gain full traction. This news has given the market a bearish momentum to push the euro lower against the greenback on the technical front. Full week of economic releases, both coming out of the US and the Eurozone this week, will set the tone in the formation of market sentiment towards the euro-dollar market for the beginning of 2014. Good morning, everybody. It's now 1 p.m. Auckland time, January the 6th, 2014, and welcome back from your Christmas holiday. This is your Forex market commentary brought to you by REAL ECN. Today's discussion, we're going to look at the euro-dollar market at the beginning of 2014. So on our first discussion, we're going to talk about the technical front. Looking at this chart, the euro-dollar market failed to retest the 1.387 high seen in late December of 2013 before the announcement of Fed tapering action. Nevertheless, the euro did test the 1.3800 level on the last day of 2013, which is December the 31st, forming a short M top on the Bollinger Band. A characteristic of a M top is that the trend first closed above the Bollinger Band, but later, as the trend developed, weaker momentum causes the euro to lose buying momentum and close slightly below the previous high and below the upper Bollinger Band. Starting the new year of 2014, investors are piling onto the bearish momentum trade as euro selling pressure forces the trend to consistently close below the low red Bollinger Band, which is indicative of a strong bearish momentum. Also adding to this bearish euro view is that the euro had been trading below the 30 weeks moving average since January 2014. Short-term on the hourly chart established on the Fibonacci resistance at 1.3606 and the support at 1.3572, with the euro open today at Sydney trading session slightly above the support level. So a breakdown beyond the support level when the European trading session commences will not come as a surprise. An analysis of a collection of technical indicators on the 1 hour interval euro-dollar market suggests a bearish market sentiment on the euro and recommend short positions on the euro. So let's closely analyze the collection of this technical indicators. Remember, this is on a 1 hour time interval. So first of all, we're looking at the RSI, which is the relative strength index. The price value is at 41.93 with the technical recommendation of a sell. Moving down 2 notches, we're looking at the MACD, which is the moving average convergent divergent. This supports a bearish momentum as the 12 days moving EMA sits below its 26 days EMA with a price value of minus 0.003 with technical recommendation of a sell. Moving down 1 notch, we have the ADX, which is the average directional index. When the average directional index sits above the 25, it indicates a strong trend, supporting the view that the bearish trend is in full traction. Right now, it has a price value of 46.744 with technical recommendation of a sell. Moving down 2 notches, CCI, which is the commodity channel index. It's now sitting at minus 115.1188 with total recommendation of a sell. Remember, CCI, it confirms the buy or sell signal. If it sits below a 0, it shows that there's a strong selling momentum taking place. Moving down 2 notches, as you can see, there's the ultimate oscillator. So when the ultimate oscillator sits below the 50 mark, it means that the trend is in a bearish territory. Right now, we have a price value of the ultimate oscillator sitting at 43.263 with technical recommendation of a sell. Lastly, our last technical indicator we're going to look at is the bull to bear power ratio with price value of minus 0.004. If it's a negative value, which means that the bear have more power over the bull, which is a straightforward recommendation of a sell. So overall, we have 0 buy, 9 sells, 1 neutral, and overall technical consensus of a sell. Moving on to the fundamental front, we're going to discuss the fundamental for the euro-dollar market. So in the US last month, the Fed's tapering action of its $85 billion a month in mortgage-backed security and long-term treasury purchases by the rate of $10 billion a month have shaken market sentiment towards its open-ended QE program. Now, expectations building up for the scheduled tapering calendar to play out based on the resilient recovery of the US economy amid the backdrop of a sluggish growth and continuation of easing program being pursued by the Fed's central bank cousins, the ECB and the BOJ. With investors and speculators returning from the Christmas break, market sentiment, liquidity, and participation's convictions are building up, setting the underlying tone for 2014 trade surrounding the upcoming market-moving events such as the next ECB meeting, the German CPI core data release, and on Friday, US non-farm payroll release, and the last one, which is the US Senate confirmation vote on Janet Yellen Federal Reserve Chairman nomination. In spite of investors' consensus in 2013 perception that the Yellen Fed can prove to be more dovish than that of Bernanke, others believe that the Yellen Fed's mandate emphasizes its key focus on unemployment rate. Janet Yellen understands that the interbank lending had been floating at a new low since 2007, which is largely due to the zero risk and high interest rate that commercial bank gets from depositing its money at the Federal Reserve, rather than lending it to each other or make loan that is perceived to be high risk attached to small businesses and bank. One potential action by which the Yellen chairmanship can take is lowering its interest rate by which bank gets from depositing its money with the Federal Reserve, thus encouraging the bank to seek high-yielding return and taking on more risk by making new loans to corporations and small businesses. Business expansion and job creation hold precedent to the underlying money velocity which form the backbone of the U.S. consumer spending and core inflation report. Over in the Eurozone, December manufacturing PMI report across the major core European centers such as Germany, Italy, Spain, as well as the Euro periphery, show a slowdown yet promising PMI data, sitting comfortably on an average above 50 level, indicative of growth. This reinforces expectation that recovery is gaining traction despite the nature of the recovery itself can be described as sluggish. The news was later tainted by a weaker than expected French report, Eurozone's second largest economy. This has investors downgrading expectation for French future growth in business and employment, which only begs the question, is this policy crisis in France painted itself as the next European victim in need of the ECB rescue? November ECB rate cut was perceived by the market that any future ECB rate decision would be based on Germany's policy towards deflation or easing. Germany's economic report can provide hints and signal expectation direction towards ECB future action. Since the November rate cut to 0.25%, it normally takes 6 months for the easing effect to reach the European economy as well as housing markets. So another rate cut or easing policy from the ECB in Q1 of 2014 would be deemed as very unlikely. So lastly, we're going to look at the economic calendar for this week. So on Monday, we have the Eurozone PMI service data coming out, which is in line with the prior PMI data of 51. Also, the US ISM non-manufacturing PMI expected to be at 54.5 with prior at 53.9. On Tuesday, we have the German unemployment rate expected to sit at the 6.9%. On Wednesday, we have the ADP non-farm employment coming out from the US. Remember, ADP non-farm employment data is very important because it highlights the private sector hiring and its expansion of small businesses. So with prior added of 215K with expectation of another 200K added new job. On Thursday, this is in line with the market consensus, we expect the ECB rate decision to stay at 0.25%. Also, U.S. jobless claim expect to drop from the previous of 339K down to 335. Friday is the major market moving date, which these releases were tied up and finished this week. So on Friday, the number one most important market moving data is the US non-farm payroll. We expect nearly the same as November's of 2013 of 203K. So with forecasts of 170K for December. And another one is the unemployment rate with expectation to be in line with prior of 7%.